Hello, this is David Jensen with your October 28, 2023 Economic and Markets Update. The title of today's discussion is JP Morgan CEO Jamie Dimon appears frightened. Why? First of all, if you like this presentation, please give this video a thumbs up. It helps a lot in terms of getting exposure for the presentation. And these are the social media platforms where I post information. By the way, many of these slides are posted on a rolling basis. I tend to focus on Gab in terms of getting the information out there, so please have a look there during the week. Okay, so Jamie Dimon is speaking out, words and actions. So Jamie Dimon is the CEO of the largest bank in the U.S. JP Morgan holds $3.9 trillion of assets, to give you an idea of its size. Dimon, because of his position, his warnings and actions have meaning. And he's not someone that has spoken out frequently in the past, and it's strange to see that we've got three events here in a very short period of time by Dimon that should have our attention. So let's review and try to determine why he's acting so frightened. So the first event was September 26. Dimon spoke out and said that he thought rates were heading to 7%, and he was uncertain that the economy could take it, and he was urging his clients to batten down the hatches, is the quote that was used, to prepare for the higher rates. Keep in mind that there's $95 trillion of total system debt on all levels in the U.S., and that this 7%, if it's sustained for any length of time, would translate to an added $6+ trillion of added interest burden on the U.S. economy since the Fed started raising rates in March of 2022. The next event was October 24, and Dimon spoke out and said the Fed was 100% dead wrong with their forecasts, and that they had an omnipotent feeling. Keep in mind, this is extraordinarily unusual for a banker of his stature to be attacking the central bank central planners. So that was the second event, October 24, 23. And then now on October 27, 23, there's been an announcement that Dimon is selling 141 million of JP Morgan stock starting in January. So that's the third piece there that's really in such a tight cluster in 30 days. It's very unusual to see this type of warning coming out of such a senior person. So his words and actions signal fear. As I said before, it's unusual given his stature, and his action in selling the JP Morgan stock is implying that he's trying to extract his wealth before further events. He's got more than $1 billion of JP Morgan stock, and it's certainly interesting. A question I have is, will he leave his cash in a JP Morgan account? Remember from this presentation that the banks don't hold the cash. We're told, you can go to my Substack and have a look at that again, that the banks directly hold about 2% of their cash that is due to deposit holder deposit accounts. So it's a highly leveraged system, and everybody is not going to be able to pull their money out. If they start to turn, it takes a relatively few number of people to have a disproportionate effect on the system. So let's see what may be striking fear. Dimon, remember, he told a banking analyst back in 2013 who said he would hypothetically move capital from JP Morgan to a bank with a higher capital ratio, and he said, in jest, I assume, that's why I'm richer than you. It'll be interesting, given his bravado back in 2013, how that translates into action. Will he leave his money in an account, or is he going to move it into secure real assets or assets out of the system? So what is eating Dimon? Why is he anxious? Let's have a look at indicators. First of all, this slide shows the U.S. economic indicators, and they are now the blue line on this chart here. You can see that they're now strongly negative. These are Conference Board numbers, a graph that's created by them, and it indicates that that things are not heading in a positive direction for the economy. You can see what's happened the other times that the blue line has been negative like that. We can also see large corporate bankruptcies here. I posted this on Gab. And you can see here we've got a spike in large corporate bankruptcies. So at a very high level here, and it's heading upwards. So that's not a good indicator for what's going on in the economy. We can see what's happened in the past, and looking back to 2000, a similar type of event happened then as well. Okay, and then inflation and interest rates, they look likely to head higher. The blue line here that you can see is the consumer price index change year over year from 1966 to 1982. So that's the blue line. And then we have this 2013 to 2030 is the dotted line here. Really, it only goes to 2023 because it's what we have the data for. But we can see here that when you map the two together, there's a very close correlation in terms of these legs up. And it looks like the CPI at 4.2% has turned and is starting to head higher now again. So we will see where that goes. But there's been a lot of what I think is foolish chatter that the Fed has won the battle against inflation. But we know that the money stock, the money in the system, was increased a tremendous amount in the last few years. And I think it's unlikely that we've seen the end of real goods price increases. Let's take a look here at inflation in the 1970s period, since we've drawn an analogy there on the previous slide. And what we can see here with the red line, which is the M2 money supply, this is year over year change. You can see that it's gone through a number of waves in the 1970s and into the 1980s, and that has typically translated with some delay into higher goods prices. So this is the CPIU, the Consumer Price Index for urban consumers, and you can see that there was money printing and a rise in goods prices. Money printing again here over 12.5%, and then a rise in the CPI and the inflation number, inflation index, pardon me. Again, another spike in money printing above 12.5%, followed within a few years by another spike in goods prices in the CPI. 1980 here, roughly, this is when they had to raise interest rates up to 19%. And you can see that after that, after that tremendous rise in interest rates, the drop-off in the real goods prices, although there was a spike in the money printing here to address what became quite a severe recession in this time period here. But we didn't see after that a return to the 1970s style wild price inflation. Now, since 1987, that's the year that Alan Greenspan took over at the Fed with his policy of the Fed put, which was basically blowing bubbles to address prior bubble collapses. We can see that the price inflation in general, was maintained below 5% for a long period of time, until recently here we can see that it went up to over 8% last year. In 2021, but in general, it's been quite contained. It's started to leg up now, as we've discussed previously here. But in general, so where did all that money printing go? Where did the price inflation go? Because they were running annual increases in M2, was regularly hitting 10%. So where did all this money printing go? Why didn't we see prices rising as they had in the 1970s? And the answer is, I think that the money printing with gold and silver price discovery controlled hiding monetary inflation action, the Fed's juice went into the markets. And I ask you please take a look at this presentation here. The Bank of England central bank gold price rig now leads to global collapse. And that details how gold trading went from trading actual bullion bars to trading promissory notes, and how that replaced the requirement for having gold and silver to trade it, and they could basically convert gold and silver into virtual assets, which could be created to infinity. But what we've seen then is that as the price of gold was capped for a long period of time after 1987, it dropped to $250 at the brown bottom in 2000, and it's on the way back up now. But what we've seen is that that the money printing didn't go into consumer goods prices. You can see again here this maintenance of a relatively low CPI with this lower curve. But when we look at this curve here, this is the S&P 500, and it has increased today to it's roughly 6.5 times what it was back in 1987, and went well over 7 here at the peak. Relative to what it was at in 1987. So this, I believe, was the Greenspan policy, was to knowing that the price of gold was fully tethered and they had turned off the warning system, that they were able to blow these a series of stock bubbles and a bond bubble, by the way, by running interest rates down to 0% from 19%. It caused a tremendous increase in the value of bonds. But now, again, with this tremendous spike here in M2, you can see that it went over 27% year over year. And in a 2-year period, they increased it by 42%, which is a lot of currency to put into the system as a medium of exchange. And we can see here that the prices started to rise again. The CPI went up over 8%. And that we're now seeing that we've broken out of this historically low inflation regime, and it appears, as you've seen from the prior slide, that we're starting to head back up in prices again. This just gives you a sense here of the level of money printing when you look at TMS. TMS is the true money supply. It's an Austrian measure. This graph was put up by Ryan McMacken there at Mises.org, so a wonderful, clear map. I've annotated it with these dotted lines here of when there's recessions. But you can see here that there's, by measuring the TMS, the annualized change here hit 40% at its peak, and over a 2-year period, the amount of money on a TMS measure went in, going into the system increased by more than 60%. So it's an incredible amount of money printing that's gone on after 2020. So what we see now, though, today is that all that money printing by the Fed is not working. We can see here that there's been a downturn in Q3 in real disposable personal income. So we're told that the GDP is increasing by 4.9% in Q3. So with all that tremendous alleged economic activity, yet we're seeing a downturn here in the real disposable personal income that people are seeing. And when we look on an annualized basis, it looks not good at all. We can see here that the real disposable personal income is the lowest since 1960, and it's about negative 5.5% here. So things are not going very well in the economy. We can see why people are suffering given this stat. So going forward, what's going to happen with interest rates? We can see the damage that they've caused so far. The rising rates have caused to the bubble economy that the Fed has created. So we're getting two very different stories here about where the rates are headed. And Rick Santella here in October gave warning that the rates are headed towards 13%. So similar to Dimon, what he was saying, just a difference of scale here. But they both are in agreement that rates are headed materially higher, and yet we have at the same time Janet Yellen telling us that their models are that interest rates are headed below 1%. So it's going to be interesting to see which it is. Some people have said it'll be 13% first and then it'll hit 1%, but I think it's unlikely that the Fed can maintain such low interest rates given the amount of juice that's already in the system. And if you have a bond market upset with a stock market upset, it's likely the rates will go higher and not lower. So let's have a net look forward at what's going on. My belief here is that we're going to see rising prices to continue because of the amount of money sloshing in the system from the Fed's amount of currency, really, not money, because we use debt-based currency, not money, which has intrinsic value. But we're going to see a continuation of rising prices. As a consequence, we'll see a continuing rising rates. Citizens are losing and going to be losing more real disposable income as the economy is now so distorted from the prior waves of money printing, and that we're likely to see bonds and stocks with a positive correlation and heading down together. They've started that recently, just like in the 1970s. They're trading together as opposed to in opposite of one another. And I think there's going to be likely a precipitous drop at some point in both stocks and bonds as the inflation continues to bite, forcing rates higher. Capital is likely to move from stocks and bonds, which are heading into decline, into the tiny real asset sector. So real assets being food, energy, precious metals, commodities in general, etc. And that will drive a sudden price inflation as that tremendous tower of debt and equities start to devalue heavily. That the massive bubble in the bond market and the stock market is going to come down. Is going to unwind, and that capital is going to start to reallocate. So we're potentially heading here for a currency crisis at the same time, I think, because of the problem with interest rates and the Fed's money printing to date, with the sudden onset of price inflation, which I think is very, very likely to come. Centrally planned fiat currency is not working again, parenthetically. So the Fed's action is stressing gold. Demand is stressing the gold market. We see now here that the gold lease rate, which is what a trader has to borrow metal for when they're trading these promissory notes, they get asked sometimes for delivery, and they do that by borrowing gold for a period until they can get it from a refinery or other sources. And we can see now that the 3-month lease rate for gold is up 3.4% now. By the way, this level, you can't see it here, but that's the level it went to in 2008 due to the metal shortage that was hitting the market at that time because of the crisis. And that subsequently drove the price of gold up by 2.5 times in about a 3-year period. So we're heading to this situation again where there's going to be metal shortage. And what metal shortage, we've seen it in 08 in gold, and we've seen it in 2016 with palladium, is that the actual physical metal shortage drives the paper player, the bullion banks in particular, out of the market because they face the risk of default if they continue to sell these unbacked certificates into the market. And what happens then is that the market starts to become either real or quasi-real. You could say that there's still some paper trading, but the high volume pressuring of the price using digitally created gold and silver is no longer effective when there's bar shortage. You've got to have the bars when there's a bar shortage because contracts that are sold into the market, they get asked for delivery, and the seller then faces default. So anyways, that's the update for now. I'll leave you with this thought here. Gold and silver, keep it in mind as we're ending 110 years of centrally planned currency. It does not work, and it's totally open for abuse by the inside players. Okay, once again, these are my social media platforms, and I invite you to follow what I post there. And please comment below in Substack or add your comments here on these media platforms. Thank you.